So in this session, we're going to try and decode this concept of return on equity and how do we really go about interpreting this metric, right? It's a fairly straightforward metric. As the name suggests, it stands for net profit that a company generates divided by the equity value that a company has on its balance sheet, right? Now, a couple of points you may want to kind of recap very quickly for those uninitiated at this point of time is any firm would basically have assets and liabilities on their balance sheet. Assets will include long-term assets and will include current assets, which are shorter term in nature. Liabilities will include equity, will include long-term liabilities, which is basically debt broadly that you've taken, borrowings, and will include current liabilities that are there, right? Think of equity as the amount that the balance sheet of the company says an investor will get if the company was to close today. So think about it. If the company closes today, the company will sell all these assets. They will repay all these liabilities, external liabilities. What is left is the book value of equity, correct? That's also called the book value, by the way, right? So when you talk about the price to book ratio, that's this equity value, correct? Now that's what your return on equity is. And when you're looking at return on equity, you're basically saying how much profit the company is generating on this value of the equity. The concept of equity is broadly, or book value is broadly, that, if let's say the business were to close today and the numbers on the balance sheet are correctly reflecting the position of the company, then this is the bare minimum you should be getting, correct? If your total assets are worth 1,000 and your total external liabilities are worth 800, and logically, if you sell this company, you should be getting 200 at this point, assuming the balance sheet is correctly reflecting the value of the assets and liabilities, right? That may not be true in some cases, but broadly, assuming that that is the case, you will assume that the minimum you will get if you buy this company would be that 200, right? This is also the money that shareholders have put into the company, correct? So you're trying to identify what is the return on this, right? So think about it in this context, that if you are looking at this as a metric, if you're looking at this as a concept, what is it doing? So take a very simple business. I'll just use some mathematical numbers to explain what it means and how do you interpret it. So let's say there's a company that starts business with some shareholder equity, right? Let's say the equity is 100,000, right? At this point, when the business starts, let's say I and you get together and start a business, 50% market share each, or a bunch of us get together and start this business. We have this money that we have pulled in. This money should be available in the bank account of the company, right? So the bank balance should reflect 100,000. That's basically a balance sheet. On one side, you have liabilities and equity. On the other side, you have bank balance at this point, which is fixed assets or assets at this point, right? Now, at some point, you could choose to say, okay, let's buy some assets, right? So what's going to happen is you're going to remove this from the bank and you're going to go and buy fixed assets worth 100,000. We start a business, which gives us this fixed assets worth 100,000. And now let's assume at the, just to keep things simple, let's assume that this equity was basically a function of 10,000 shares of 10 rupees each. 10,000 shares, 10 rupees each. That puts in the 100,000 equity, correct? Now let's assume over the course of the year, the company does some business and that business gives you a final profit number, cash profit number, right? We'll keep things simple, a profit number of, let's say 20,000, right? A profit number of 20,000. This is after you have basically taken out all kinds of expenses, after you have refurbished all your assets so that the value of the fixed asset remains 100,000, you made this profit. Logically, this profit is available in your bank account, so it should appear here. Correct? Now, there are two things you can do with this. Either you can distribute it to the shareholders, in which case 20,000 is given to the shareholders as dividend, and the equation goes back to 100,000, 100,000. Or you can ask with those shareholders whether they are willing to reinvest this money. Shareholders say, okay, good. How does the shareholder evaluate whether he or she has to reinvest? If you were the shareholder, you would evaluate that, look, we put in 100,000, we've made 20,000 profit this year, right? That's your intuitive discussion of return on equity. You're looking at the net profit of the company, which is 20,000, and you're dividing it by the equity, which is 100,000. And you're saying, okay, we made 20% return. What's the point of taking this money out? If I take it out, I'll put it in my bank account. That'll give me 5-6% post-tax. Why don't I reinvest it? If you reinvest it, this money is inside the company. Now the company has used this money as a source of funds, correct? If the company is going to be using this money as a source of funds, then something is wrong here in this balance sheet that needs to adjust for that change. So you'll add a line item called reserves, retained earnings, reserves, other equity, whatever you call it. And that 20,000 has to come here, correct? You can also look at this as the overall claim now in the company. We all put in 100,000 and now 20,000 is also our money. We are shareholders. So total claim is 120,000. Remember, the number of shares has not changed. So logically, at this point of time, the price per share as per book of account should be reflecting that change, right? That's book value per share. That's 12, correct? In this case, simple. So far, so good. So the evaluation point is, am I making enough profits on the amount of money that I have invested in the company? And if I am, I might choose to reinvest. If I'm not, I'll try and pull this out. That's the logic. Fair enough? Understood where it is coming from? So for all practical purposes, return on equity, the equation is fairly simply net profit divided by total equity value. Equity value includes share capital. So this would be classified as share capital plus reserves. So you look at total equity that comes out here. That is your return on equity number. So far, so good. Clear? So that's how return on equity gets calculated. That is what is going to come up, right? Now, remember, when you're talking about these stocks, face value is always going to remain constant at this 10. This now 12 rupees is the book value, right? In this particular example, anything over and above the face value gets adjusted either as general reserves, or you could go and do an IPO, in which case you'll issue the share at, let's say, 300 rupees, in which case 290 rupees per share value goes and sits as what is called a share premium account. But the face value is only 10. Face value is a largely meaningless concept. It is irrelevant, right? For all practical purposes, right? It could be 10, it could be 100 for all you know, it could be 1 for all you know, it could be 5, doesn't matter, right? So that's the context as this concept from the broader viewpoint of return on equity. Now let's dig deeper. So there are a bunch of questions that come up with respect to ROE, right? Is rising ROE always good? So let's say if I was to ask you about a company whose ROE goes from 20 to 22 to 24 to 26, is this great? Percent, of course, right? Is this always good? Or could it be neutral in some cases? Could it be distorted based on certain challenges that could be cropped up, right? Is falling ROE always bad? So let's say the ROE goes from something like 30 to 26 to 22. Is that always bad, right? That's something that we have to kind of check. Now, what is a good level of ROE? You would assume that higher the ROE, the better it is. But I mean, at what point do you basically consider it's good enough, right? And at what point does that good enough start becoming abnormally high, right? So is that 20% good, or is that 80% as a good number? How do you define it? I mean, of course, 20% would be reasonably good. Given a choice, you would want 80, but is 80 correctly reflecting the entire situation or not? That needs to be understood as well, right? And the final point is, what does it reflect, right? What is it exactly telling you? So let's take the final question first. You're saying that an ROE is, let's say there are two companies, companies A and B. ROE of one company is 5%, the other company is 15%, right? Now think about what the shareholders are asking at this point of time. Every year, when the company makes profits, you can calculate the ROE. The decision that the shareholders have to make is whether they reinvest or they pull out, correct? Whether they reinvest in the company or they pull the money out of the company. This decision is subsequent, this decision is contingent to the idea that you're making reasonable returns on the money that is invested. If you're not making reasonable returns, you will tell the company, look, please give us the money in the form of a dividend. I can go and invest it elsewhere. I mean, technically, if you were this shareholder in company A, you'll say, boss, you are generating 5% for me. Give it to me as dividend. I will take this money out. I'll go and put it in a nifty index fund and I'll make probably 10, 11, 12% annualized on that. Or even if I put it in a fixed deposit or a government bond, which is going to give me about 7% yield, a post-tax return might actually be similar to what this number is, right? In certain cases, I could look at instruments that are giving a post-tax return of 5.5%, 6%. So why would I actually keep my money in a instrument that is going to give me 5% return on the money that is invested? In fact, you'll go and tell the company that give me also a lot of money in terms of the earlier reserves also that you hold, give it out as dividend. I mean, there could be more money here in terms of the reserves. Even give that out as dividend because you clearly don't seem to be using this money well. Right. This is where a lot of other points also start coming in, right? Which is, for example, a lot of companies sitting on cash, they tend to go and invest this cash in stock markets, right? And that's again, a question that comes up, that why would a company invest in other company stocks? It all works well in bull markets, but theoretically, if you don't have use of that money in your business, give it to me. I can invest it myself, right? Why would I want a company to invest my money, which I've given to them to run their business, to be invested in other companies, right? So it all starts from here. The base question you're asking is if a higher ROE gives you access to capital, and the answer is yes. The key points that ROE, or as a related metric, return on capital employed, ROCE, reflect is that if your ROE is high, you have continuous access to capital. You can go back to your shareholders again and again and again and tell them, will you give us more money? We want to raise more money. Will you give us more money? They will give you more money because you're generating a good return on the money they've given to you earlier, right? Higher ROE basically defines access to capital. Access to capital defines a huge entry barrier. HDFC Bank today, or a private bank today, any private bank for that matter, can raise capital at will, right? And that's because they have exhibited higher ROEs over this period, notwithstanding the recent sort of challenges that the bank is witnessing with respect to their merger. It's a well-run bank. So if you continue to demonstrate higher ROE performance, your shareholders are generally extremely happy giving you money. Correct? So far, so good. Is this clear? Yeah. So that's the first part, that what does ROE reflect? If your company is a high ROE business, it will always have good access to capital. It's easy. So that's the core part that kind of comes out. Lower ROE businesses, it is not necessary that they are bad businesses. They could be intermittently bad. And you also have to see that, is it like a perennially low ROE business, or is it like a couple of years where the business has gone into trouble? That's a possibility, right? Sometimes businesses are doing well and then they are not doing well. They struggle. Technology changes, market conditions change, regulations change. Companies are probably, they end up making a mistake, like going and acquiring another company. By the time they realize the mistake, there could be losses on that entire acquisition. So there is a possibility that ROE can fall intermittently because of this. But your idea is to look at sustainably, is the company able to generate a higher return on equity? In fact, companies that have a better return on equity are generally efficiently using shareholder money because they are able to generate returns. If this company goes and puts a bid for a low ROE company, you will see the low ROE company shareholders getting very happy about this entire thing, purely because they will feel that, the assets can be utilized better. So synergy can kind of kick in. So that's the construct of how do you interpret ROE? What does it reflect, right? So that's one part around it. Now let's go into other discussions, like is falling bad or increasing bad and all. So let's take case one, right? How do you interpret this? Imagine a company with sales of 10 and net profit of 20, right? Does nothing, sells some 100 units for something. The cost of all those units is 80, right? So 100 minus 80 gives you 20. Assume equity to be 100. So what is ROE? ROE will be 20 upon 100. That's 20%. That looks good. We've calculated. Now move ahead. Assume sales and costs go by 10% and all profits are distributed as dividend. If all profits are distributed as dividend, the equity value does not change, right? So let's say there's the scenario, you paid out all the 20 as, so let's look at year one, right? What's going to be your sales? 10% increase. Inflation. Assume volume does not change. You've just increased prices. Assume same inflation on costs. So 80 becomes 88, 10% increase. What's your profit? 22, 10% increase. Correct? What's your equity? Equity has not changed because you've not adjusted the balance sheet value for inflation. That you haven't done. The balance sheet value remains the same. What is ROE now? ROE goes up to 22%. Next year, same logic, increases by another 10%. This will become 121. This will become something like, 97 or something. Your net profit will be 24.2 to be precise. Equity is still 100, right? 24. Equity is not adjusted for inflation. Equity is there because balance sheet carries things on historical cost basis. It does not evaluate or change that. Because it doesn't change that, logically, for a company that is going to kind of keep distributing everything as dividend, as long as there is a minor inflation, return on equity will keep going up. This will only get corrected if you try and reevaluate the balance sheet in some form or fashion. Luckily for us in India, neither have we reached that stage that a lot of companies end up giving a large amount of dividend, right? Nor have we seen like crazy amounts of inflation kind of kicking in, that only inflation is going to disrupt and go and look at that point. So we haven't come across this situation, but theoretically, if a company keeps sort of growing just by inflation every year, keeps growing profits by inflation every year, you are going to see ROE increase. It is actually not a very meaningful point because you realize that that money that you had put in logically is sort of, not really generating a bigger return on that because your money is also, kind of technically your investment should be also inflating at that rate in that context, right? So that's one way to look at it. This also kind of extends into some other interesting phenomenon. To take another example, which is a big challenge with something like return on equity. So case two, we pick up Tata Motors, and I want you to specifically focus on years 2019, 20, 21. What is the net profit? There's a loss, there's a loss, there's a loss. Correct? Now, these losses are a problem, but you would realize that most of these losses were actually coming from exceptional losses. If you dig deeper, I won't go into a lot of detail here. What the company was doing was basically writing off assets, right? So what do you mean by writing off assets? They had invested in some intangible assets. They do a lot of R&D from the perspective of new vehicles. They had invested in assets. They just wrote it off. So this expense or these losses are basically non-cash losses. Why are these non-cash losses? Because the money was already spent. You were just accounting for it across multiple years, right? Let's say you buy an asset worth 100 crore and you say useful life is 10 years. So you'll depreciate 10 crore each year. And somewhere in between technology changes and you say this asset is not useful anymore. You'll write all of it in one shot. Let's say that happens in the third year. So you'll write 80 crore in the third year, write off 80 crore in the third year, correct? Because that would have been the value remaining after 2 years. This 80 crore is not a cash loss. You already spent 100 crore in the first year. So cash is gone, right? You're only accounting for it in multiple years. Net profit is an accounting metric, right? Net profit is an accounting metric. The problem with net profit being an accounting metric is if your accounting understanding of earnings is distorted, like in this case, it was distorted downwards, you'll get a negative ROE number. In some cases, you might get it distorted upwards because the company is showing great profits, but not collecting money, for example, right? Cash flow doesn't exist, but profits exist. there could be a distortion in return on equity on that account. So a higher or lower number has to be looked at in the perspective. In this particular case, look at the equity values. The equity values kind of, because they're making some losses, the equity value actually keeps going down. And so you'll see a very big number in this year. So neither were these correct, nor is probably this correct, because now the equity is eroded because you have hit the losses and taken it off the equity or some part of that over the equity. So if a company that is making losses for multiple years suddenly shows profits, remember your losses keep going and hitting the reserves. So your equity value keeps going down and down and down and down. And then suddenly you show a big profit. That year, you'll see a big earnings jump. I'll show you some examples of that as well as we go along. Understood. The second problem with ROE, or when you decode ROE, is remember that return on equity is dividing net profit by equity. Net profit is an accounting number. Accounting number is susceptible to your accounting policies. If you choose to sell on credit and not collect the money, ROE might appear to be good, right? But you are not necessarily solving the problem, right? And some of this can get captured in some of the other analysis you could do. We'll talk about DuPont analysis as we go along, and that could probably capture a little bit of it, right? Let's go one step further, right? If you go one step further, look at the third case. So this is Hindustan Unilever, HUL, right? Look at, again, the numbers broadly across the years. Look at calculating the ROE somewhere here. 5,200 crore profit and about 7,000 odd crore equity. 5,000 by 7,000 would be approximately a 70% ROE. Next year, 6,000 crore profit, about 7,800 or 900 crore this. So 75% ROE if you just calculate ROE. Third year, 6,700, 8,000. So you'll look at about 85% ROE. Correct? Look at what happens here. What really happens is that the reserves jump up. And as the reserves jump up, your equity value changes to something like 48,000 crore in the denominator, and the numerator changes to 8,000 crore. Right? Now this number is approximately going to be about 17% or something. So your ROE has gone from 85 to 17. The recent number, latest number that you see would be 10,000 by 50,000. So that's going to be approximately about 20% ROE. So this is a company whose ROE was 80% here and has become 20% here. Now comes the question, what happened here, right? So two things. If you're aware of this particular case, then you will probably remember that HUL went and acquired a company or the business of GSK Consumer. Horlicks and Boost was basically acquired by HUL. And when they acquired this business, they acquired by issuing HUL shares, right? So if you look at HUL's balance sheet, which is available here, you will note that in 2021, this transaction happened. You see a large jump in fixed assets. This fixed assets, if you go and click on this plus in the website, I picked this up from Screener. If you click on this plus, you will see will be some fixed assets, a lot of intangible assets, and some goodwill, right? That has all come up on this side. Obviously, because you've paid for the brands Horlicks and Boost, you've paid money. Those brands are not reflected correctly in what fixed assets are there. So you paid some 40,000 crore for that. That increased the fixed asset. How did you pay for those 40,000 crore? By issuing HUL shares. Because you issued HUL shares, share capital went up, right? That went up from 216 to 235, which means approximately a 10% dilution, right? HUL's market cap was about 4 lakh crore. 10% dilution will give you 40,000 crore. 40,000 crore went and acquired GSK Consumer. This number is in lieu of the share premium account. You're issuing shares not at 10 rupees, but at the current market price. When you issue that at current market price, that 40,000 crore premium comes into the picture, right? Which distorts this thinking. So one way to look at it is understanding this DuPont analysis. You must have read about it, right? I'll explain this. ROE is nothing but net profit upon equity. Now, just mathematics. I can multiply this with sales upon sales and multiply this with assets upon assets. Correct? And then I can rearrange. So when I rearrange, let's say I rearrange using net profit upon sales into sales upon asset into asset upon equity, right? So that's basically what comes. Now, asset upon equity can also be written as, you can think about assets being nothing but equity plus debt. On the other side, you have, let's assume it's just debt. So you can rewrite this asset upon equity in some form as, let me actually use another color to put this up, maybe something like equity plus debt upon equity, right? Now there are three elements here, correct? These three elements are, this net profit upon sales is your profitability element. So you're looking at how profitable the company is. This sales upon asset is the efficiency element. It's a turnover ratio. So you're checking if the company is efficiently utilizing its assets. And this third one is what is called as the leverage factor, right? Which is basically saying, are you efficiently utilizing the capital structure, right? Now, theoretically, this third number can increase. In the case of HUL, equity went up. Because equity went up, asset upon equity kind of got distorted, and that resulted in, sales upon asset and asset upon equity both went down because assets also went up and asset upon equity also kind of went up. So because of that, the asset and equity values went up. So the denominator kind of the value came down. The overall asset upon equity and sales upon asset values came down. Because of those coming down, you find that net profit upon sales did not change. Net profit margin was the same across the years. But because these two elements kind of came off, your return on equity fell. A company could theoretically also raise a lot of debt, right? And spend all that money in marketing. Let's assume the sales of the company is 100, costs are 80, net profit is 20. Company takes a lot of borrowings, right? Spends all of that borrowing in marketing. Sales goes up to 110, costs go up to 88, argument's sake, because interest cost, etc. will also go up. Marketing costs will go up. You make a profit of 22, equity has not changed. The impact of this borrowing is going to come later, right? In terms of reduced ability to repay money and, increased risk perception and all of that. But if you borrow money today, it could distort ROE upwards. So it is important by doing DuPont analysis that you decode ROE, whether it is changing because profitability is increasing or decreasing, efficiency is increasing, decreasing, or leverage is increasing, decreasing. That has to be kind of clearly understood. In HUL's case, we just saw what happened, which brings me to the fourth point, which is, this is obviously one element around it. But if you actually go to this website screener and you can run screens around that, you can run a screen on a particular set of parameters. So I ran a screen, right? I said return on equity should be more than 40%, ROE greater than 40%. Average ROE for 5 years should be greater than 40%. So today also more than 40%, and average across 5 years also more than 40%. And market capitalization greater than 30,000 crores. So large companies. You run this, you'll get this list. There are 8 companies here, right? Some 5 or 6 out of 8 are very similar-ish. You'll see Nestle, you'll see P&G, Hygiene, you'll see Colgate, Palmolive, you'll see Page Industries, you'll see Britannia. Kind of FMCG or consumer companies, right? You see TCS, you see Coal India, and you see LIC. LIC is a distortion because they've just listed and their equity is very small because the government has just issued a very small amount of equity, right? So 96%, 97% is still held by the government. So their equity is not a correctly reflecting scenario and their profit suddenly shot up. So they are giving a distorted sort of average ROE that is kind of coming out, right? And before this, there was actually no equity. It was a very small equity till the time it was not listed. So that's distorted. Coal India, I think, is again a set of an example of companies where profits have increased because coal prices have increased. They give out a lot of dividends, so equity value doesn't go up as much. They keep churning that out. Same is the case with TCS and most IT companies. They give out almost 85% of their profits out as dividend or buybacks. So equity does not go up. As long as there is an inflationary increase in profitability, you will see ROE is remaining high and healthy. There's another point that is there because the other 5 that I have listed are very similarish companies, and I have put this data for those 5 companies for us to evaluate, right? The point you want to try and evaluate is when you go to somebody like an HUL and you look at their P&L, and this is an important point that you would want to kind of understand, is if you look at this P&L and balance sheet in the year 2019, right? This is a company, take a look at 2019, their overall liabilities are 18,000 crore. With this 18,000 crore, and if you look at assets, they are working with like 4,000 crore fixed assets, right? With this, they are basically generating in 2019 a sales of nearly 40,000 crore and a profit of 6,000 crore. This is not a capital intensive business. The total cumulative assets used are 4,000 odd crore, and they're generating a net profit of 6,000 crore. There is no real receivable in this business. So this is all cash. And you can basically double the capacity by just cash profit of that year, correct? If they want to. So the balance sheet is a distorted balance sheet. It is not reflective of the true value of this business. Why is it not reflective of the true value of this business? Because businesses that are not capital intensive, the value of them does not lie in the fixed assets which are demonstrated here. The value of this is in the intangible assets they have built over the years. And intangible assets would include assets like brands. Correct? The problem is you can't value the brand unless it gets sold. Unless the company goes and acquires another company, like what happened with GSK Consumer Healthcare. When GSK Consumer Healthcare got sold, that's when the true value came out. If you had looked at their balance sheet, that would have appeared like some 3,000 crore again, right? But they were paid 40,000 crore for the brand. If HUL today goes out and says, I want to sell the Lux brand, that Lux brand is going to probably be bigger than the existing fixed asset value on the balance sheet if you look at 2019 values, right? Because of this, these companies have distorted values on the downside with respect to what their true value is. Nobody went and upgraded their estimates of what the value of this company would be. The market knows about it, which is why market cap is 4 lakh crore or 5 lakh crore at that point of time. Now it's about 6.5 lakh crore. But the balance sheet doesn't reflect it. And because the balance sheet does not reflect it, the equity value is an outcome of what's there on the other side on the assets. Assets are carried at historical cost. The assets are not valuing what is the brand they have built. To an extent, this is also going to be true with companies like TCS, not a very capital intensive business. The asset is the brand TCS has built over the period and the fact that they have a huge workforce that is very skilled. You don't record this on balance sheets, unfortunately. Because you do not record it on balance sheets, the number tends to get distorted. So when you see this 100% value for Nestle, that doesn't tell you that if you give Nestle 100 rupees, they're going to generate 100 rupees for you. That's not correct. It is a distorted value because their balance sheet is reflecting what was the balance sheet value historically and is not accounting for the brand values that they are carrying. So when you see 100% or 80% kind of numbers, more often than not, it's a distorted number. The correct number is when HUL goes and acquires GSK and you get this 20-25% number. Otherwise, everybody and their uncles would go and give their capital to Nestle, no? Just keep doubling it every year, right? If 100% is return on equity, they don't need it. And they pay everything out as dividend. In fact, if you go and check Nestle's dividend payout ratio, they'll probably be paying about 100% of it over as dividend. So the first point also hits them, the fact that inflationary increases will automatically increase ROE. The last point also kind of distorts this ROE number, that this 80 or 100% is not really reflective of the actual business potential. That's because you've undervalued the asset on the balance sheet, right? And that's why equity seems to be a smaller number. In these cases, a correct estimate would be to probably look at what would be the value of the brand. And usually you could kind of use HUL GSK as an example and say that, your overall equity value will probably go up by a factor of close to about, 6-7 times. If that goes up 6-7 times, you add some profitability through some brands. So eventually what you're going to get, a correct estimate of these numbers would be in the range of 20 to 40%. That's a logical estimate. I think it is extremely difficult for somebody to be able to generate. So think about it this way. If you had to build HUL today, if you had to build HUL as a business today, what is happening is that all the expenses they did to build that brand has been expensed off. You've not really put it in the balance sheet. Technically, they have a brand that they've created, right? If you have to build that brand, the amount of capital you will need is not going to be this 4,000 crore. To build the branding of HUL, you can't do it in 4,000 crore, 4,700 crore. That's not happening, right? To do that, you'll have to pay the market price, and that is what your true reflective ROE would be. So 80% is distorted in most of these cases, does not mean anything, to be honest, right? In my opinion, I think at least you'll see most FMCG companies that show 80, 100, 60, all distorted numbers, not worth. You can also get this kind of a number in companies like InfoEdge, right? Where again, small equity, you make some profits, you might see higher return on equity kind of numbers. New age businesses where you do not have tangible assets and consequently your assets are not being evaluated on market price value, you will see that the market tends to sort of distort that understanding, and consequently you see this distortion that comes out in return on equity values. Simple. So far so good. That's broadly our discussion on return on equity. So is rising ROE always good? Usually it would be, but you want to be careful if it is happening because of debt. In that case, not necessarily. If this is happening because of inflation, in that case, not necessarily. You want to be careful and look at it in that perspective. Is falling always bad? Nope. That is also not true. It's possible that a company is basically giving out a lot of, repaying a lot of debt. And if you repay debt, the exact opposite is going to happen. That is one possibility, right? The second element could be the company has made losses, like we saw the example of Tata Motors. That was a negative ROE number, but those losses were not cash losses. That just written off some earlier expense, some earlier assets that they had kind of created, and that reduces that that ROE number in that context. So not necessarily. You have to decode multiple things there. One, why is it going down? Is it going down because there's a genuine loss that has happened in the business, or the genuine profitability of the business is going down? Or is it because there's a distortion in the earnings number at that point, right? The third thing you can go and look at is basically your element of, what is a good level of ROE? Now, generally speaking, anything greater than 15% up to 30 to 35% is good, right? Beyond 30-35%, more often than not, you will find that it is getting distorted. It is getting distorted because the balance sheet is not reflecting things correctly. So good for them. You can see the 100% number, but you do not go and just assume that, oh, because ROE is 50%, the company will give me 50% returns on the money I'm going to put in. That's not going to happen, right? That is not true. The ROE could be 50% because the equity value is considered low because assets are kind of a bit distorted. That is something you have to keep in mind. So whenever you see a very large number, like above 40%, you want to be a bit careful, try and check this out a little bit as to, why is this happening? Is this because this is in a business like FMCG where brand value is the real value of the business and that's not accounted on the balance sheet? Or is this because of some distortion on the equity value where you had a big year of losses, so equity went down, and then you had a good year of profit, so equity went up, correct? So let's say your equity was, argument's sake, 5,000, and you made a big loss of 2,000 crore. So this 5,000 goes to 3,000 next year when you made that loss, right? And now when it was 5,000, the year before that, the profit was 500. Now there was a loss. Let's say there was a 2,000 crore loss. And the third year, you again made a 500 crore profit. You calculate ROE here, 500 divided by 3,000, right? And you will probably get a number of about 16, 17%. And you'll say, okay, that looks good. But you need to understand that the denominator has been distorted. So there is no one size fits all approach here. Generally speaking, you want to see a trend, and that trend should denote that the number stays at least above 15% at most points of time, because that's what your return from the stock market is in general considered to be. So the least you would want your equity to kind of return is about 15%. And on the higher end, you want to be a bit careful once it goes above 30, 35, 40, purely because then it's now getting distorted. It is beyond the point it's going to lose its meaning in that context, right? So that's something that you have to be careful. So good level would typically be between 15 and 30% in most cases that you see, right? And what is it reflecting? It's basically a good ROE is reflecting your ability to raise capital at any point of time. Although you do want to kind of look at a non-distorted value of ROE, get a sense. Sometimes it's not easy, right? HUL did an acquisition, so it was fine. But if you don't do an acquisition, then you just don't know what the value is. In those cases, you could generally, you will also find that the market cap of these companies, or what do you call as price to book value of these companies, is also going to be very large. That's an indication. Also, there is a sort of Gordon growth model that links price to book value to return on equity. They're directly proportional. If you do a cross-sectional analysis of companies that have large return on equities, you will see price to book values will typically be large, exceptions being PSU entities in India. That's a separate discussion altogether, right? But generally, price to book value numbers would be large for these entities because the book value is distorted as lower. The market cap is correctly capturing the real value of the business. To set up a Nestle business, your equity value would be close to about maybe 1,000 crore or something around that. You are not you're not going to build a business on that 1,000 crore. To set up something like Nestle, you'll probably need closer to this market cap than to the equity value or assets value they have on their balance sheet. That's something you have to keep in mind. Market is a better reflection on these cases, but if you do something like net profit upon market cap, that's basically going to become the inverse of earnings upon price, which is the inverse of PE ratio, essentially. So, it doesn't really give you too much relevance in that context, right? Now, where do we go from here? The key element in terms of understanding ROE is that when you see a number like 80%, it ceases to be a relevant number in your evaluation parameter. You can be happy about it. It does not give you too much meaningful relevance understanding, right? You don't go on this table and say, oh, because their ROE is 108%, I should go and buy this stock. That's not a meaningful calculation beyond a point. That doesn't help. All other things being equal, you could consider that. But even in that, the problem is this tends to be a distorted number, right? So to that extent, use the return on equity calculation from the purview of the reflection that it is access to capital that you're talking about. A company's number between 15 to 30, 35% is a good number. This company should have no problem raising capital when they want. Is a rising ROE always good? Not necessarily. You want to be careful if that's happening because of inflation or debt raising of the company. Is a falling ROE always bad? That may not necessarily be good. You have to see whether it was because of an acquisition that something like an HUL did, or because of repayment of debt, or because there is a distortion in terms of cash earnings in a particular year. Sometimes rising ROE could be bad because your net profit went up because you chose to sell a lot on credit. The money never came. That's going to get hit in subsequent years, right? Your receivables go up. It's going to create a problem at some point of time. So all of this has to go into an interpretation. Just looking at a number and saying it is high or it is low, right? Then you look at that data and kind of consider that, right? That in a nutshell is your review of the return on equity. In itself, of course, one number doesn't tell you everything about the company. When you're evaluating, you to look at a lot of things, but do not make a judgment of a company's worthiness just looking at one number and looking at it in an absolute measure terms and saying 80% is better than 50%. So the question why 20 or 50 or 80 becomes relevant and you want to kind of go ahead is not that if I look at this table, it does not mean that Nestle is a better company than Britannia. That information is not clearly available here, right? This return on equity is not a very meaningful metric here. So that is where I think you have to kind of decode it and dig a little bit deeper when you're looking at this as a number. More to it, there are obviously more nuances, but I think suffices to say that you will kind of get into this consideration and look at some of those data points as you kind of go along. That, in a nutshell, is what our discussion was with respect to return on equity.